Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. Let's take a look at some macro information for Macro Monday. Going to start with the usual flows discussion. We do not have a James Butterfill report today, so I will stick to the Bold report and their flows data. Pretty light here on the month so far across the board. You know, we're not surging. I don't think anybody is surprised by that based on where price is going. I don't think we're going to see flows come back in a big way until we break up, if we break up from, say, 66K or something like that. I think markets across the board taking a bit of a breather. If we look at the gold ETF flows, because why not, those continue to be fairly negative here on a monthly basis. So Bitcoin's still winning that race pretty handedly. Farside has added a Hong Kong ETF tab based on the daily flows here. Again, not much going on. This will eventually change if and when things pick up, but just out of the gate, certainly not as important as the US ETFs. The good thing about having an off US ETF is that, you know, if there's some overnight excitement for whatever reason, we can sort of ping pong between the US products and the HK products. It's never going to be massive, but it's more, right? We will take more. We will always take more. They also have a minor market cap table. Just a quick little check for anybody who's ever looking for that information with all the tickers here on Farside. And then, of course, there's the BitcoinTreasuries.net, which is the global aggregated data of every company or trust that holds Bitcoin in any way. Block announcing that they will buy Bitcoin, adding to their treasury. We still have miners adding to their treasury. A few companies buying the ETFs based on their 13F filings. So this list should continue to grow over time. And even though we're down slightly from all-time highs, we're down maybe on a week-over-week basis for a couple weeks now. We are still beating the pants off of most things that most people care about. The S&P 500 benchmark, we are up 5x from that on the year. That could change, obviously. It's early in the year still, but we continue to do fairly well relative to the benchmark, and eventually just this becomes a employment risk for not including something like this that's outperforming everything in a family office or a wealth management fund, trust, whatever, right? Eventually this will get included because when you have returns like this that are outperforming, it's definitely worth a conversation. Quickly on the Bitcoin chart, I don't expect much here, probably for the rest of the month till the end of May. This may end up forming an inverted head and shoulders or something like that throughout the rest of the month, but I don't think we're going to see much of anything for the rest of the month. Any new lower lows and that bullish recovery is off the table. If we break 66 or thereabouts later on this month, I like new all-time highs. So we'll see, but not much happening fast here. Something else you can watch on low time frames, the BitX chart, 4-hour, 2x ETF. It's done a pretty good job at getting you in and out on the cloud here. And this, again, is not telling you to do anything. It's back in the cloud, completely neutral territory. And this takes us into June as far as potential expectations for a move. So I would just sit tight and maybe look for some other stuff or catch some sun, some rays, load up on the vitamin D while you can. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to our trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. So despite the nothingness going on with Bitcoin at the moment, and despite the probably necessary eventual right shoulder we will need to still put in here down to 60K, there are some non-Bitcoin charts on the crypto side that look pretty good to me. Near looks excellent. Pepe looks pretty good. Bonk looks okay. You know, so there's always something somewhere if you really want to trade something that looks decent. As long as Bitcoin can remain in a range and not fall off a cliff, alts have a chance to catch up because people get bored. Okay, if people are looking for something to trade, they're looking around, they're looking for, I don't know, whiff or whatever else, right? Some of this stuff has a chance at maybe outperforming in the near term, but the most prudent and patient traders are probably waiting for a move in Bitcoin before they really do anything major. Calendar this week, pretty light. We have 10 Fed speakers almost nonstop every day this week. So there's always that fun to look forward to, but for the most part, numbers wise, not too much going on. The big thing will be on the 15th. That is the next CPI print, where CPI is expected to be flat month over month as far as trueflation is concerned. Still ranging, not too much going on here, which is fine. Eventually, this should catch up with legacy. Legacy should catch up with trueflation rather, and come down. But that's going to take a lot of time. That's going to take probably another 6 months to a year. And that takes us past the election at that point. Looking at the Fed nowcast, month over month should be no change. But again, plus or minus 0.05%. And the market could go for a real doozy one way or the other. That's just where we're at in the cycle. Looking at May's numbers, we're only 6 days in, but that is down pretty nicely on a month over month basis, as is core, as is PCE. You know, all this stuff still slowly, extremely slowly headed in the right direction. Far too early to really tell if that's real or not yet, but certainly more optimistic than bearish. You know, if this was crushing highs like it had been post-COVID, that's a different story. So it's good to see this coming down, even though it's ever so slight. Looking at rents and OER, the components of CPI, this is probably where we're going to see most of the gains on the downside. Eventually, the argument here is this should continue to bring CPI down. It's going to take lots of time, though, to work its way through the data because the OER component is a 6-month average, I believe. So that's going to take at least another 3 to 6 months to have a significant effect there. As far as rates are concerned, next meeting isn't until June. Likely no cut or hike there. Likely no cut or hike in July as we stand today. The next move in rates suggested to be a cut in September. But again, we're butting into election season. Is the Fed going to wait until December? Are they going to care about election season? There's not a lot of room left here on the calendar to maybe do what the Fed wants to do. And I don't think the numbers up until June are enough to guarantee a cut in July. So all the more reason to just sit tight on any massive positions or changes in positions. Looking at yields, we had been experiencing a pretty significant bear steepener, which is where the long end comes up to meet the short end. What you want to see when the yield curve uninverts is a bull steepener. That's what we historically have seen, where the short end comes down to meet the long end. So it's good to see the long end calm down, but we are still experiencing an inverted yield curve, which, depending on how you want to think about this, that's actually for the better. The music's still going on at the party. We have more time to continue because it's not the inverted yield curve that kills you. It's the uninversion that kills you, that kills the economy, that kills growth, typically leads to recessionary conditions, likely because the Fed is cutting from a place of weakness, not a place of strength. So it really matters when we cut, why we're cutting. In any event, the short end of the curve is still where you want to be if you are collecting yield on anything. The belly and the long end still pretty volatile on a week-to-week basis here. And if we're talking about the long end, historically, since 2020, these things are down significantly. This is total return. This isn't even adjusted for inflation. So this is still a big yikes. And there's probably going to be some heroes who are just jonesing to buy deep into the long end, thinking that rates are coming down and the bull market in bonds is back. But, that's a hero trade. That's a widowmaker trade, potentially, if that doesn't happen. Some of this stuff has just been demolished since 2020. And we're likely to see significantly more supply than demand on the long end. We're likely to see less purchasers on the long end. So most people are assuming this continues to get worse before it gets better, as long as we're issuing what we're issuing on the debt spectrum. We had unemployment last week ticked up slightly, ever so slightly, and the market, of course, was celebrating that because to the market that meant rates coming down sooner rather than later. Powell specifically said in the meeting he would need to see a significant upside surprise in unemployment. So I doubt that moving from 3.8 to 3.9 is enough to signal some sort of immediate cuts. And if you are a doomer, you're saying, you know, the recession is coming, the recession's already here, but that's just not what we're seeing in the data, okay? And again, here's the yield curve remaining inverted. If you look historically, it's not the inversions that are the problem, it's the uninversions. That's where you typically see the eventual rise in unemployment because the Fed is cutting on the short end from a place of weakness. So we're not there yet. We just aren't. Sorry, doomers. The party goes on. As far as the long term, you know, this is the issue. The higher interest rates go, the higher inflation goes, because you've got more debt, more deficit, and it's just this spiral out of control. And this is, of course, one of the reasons why most people have turned to hard assets like Bitcoin. Certainly not why I initially turned to Bitcoin. I just thought it was cool tech and made sense. And that's changed over the years. You know, we're lucky we have something like this to use as insurance, if nothing else, for a lot of people. So that's a problem in the long term. Looking at liquidity, turning to the reverse repo chart, you can see throughout 2023, we had money coming out of the reverse repo. This represented liquidity essentially getting injected into the ecosystem. Bitcoin certainly benefited from that. In 2023, most everything benefited from this Q4 2023 onward. But now we're here, and we're in the flatter end here of reverse repo as far as what's being held in reverse repo, still around 400 billion. And that liquidity effect just isn't there, at least not to the degree it was in 2023, right? So this is probably why, partially, we are taking a breather here on trend, and a lot of charts, we're taking a pause. It's just harder to keep assets higher when we have rates where they are. There's only so much money in the ecosystem, and it's got to come from somewhere. So either you have to expand M2, which is slowly happening, or you have to drain this further, or you have to print more money, right? Something's got to give here to help buoy assets that are already fairly inflated from Q4 2023, right? Things are up pretty significantly from 2023. Here's the global liquidity from Michael Howell at Cross Border Capital. And you can see we're still turning up on liquidity, on wealth, and the projections here are continued increases on a year-over-year basis. And this is what we want to see. If you're bullish assets, if you're bullish Bitcoin, this should act as a continued tailwind for us. Places like Japan have printed more money in 4 years than their entire stock of currency. I mean, it's stuff like this why fiat fails. It just gets out of control. No one can ever control themselves at the printing press. It's just easier to print more without having any backing than using common sense here and saying, you know what, this is probably an issue. We need to course correct. Here's US M2, I believe. I don't think this is global M2, but again, that has slowly peaked up year over year. Certainly more bullish than bearish for risk assets. Not like 2020, right? We're not seeing anything like that yet, but we're not seeing the contraction we saw in 2022. So slowly but surely, things should come back into risk markets. We also had JOLTS last week, which is job openings. And if we look at the JOLTS chart as a percentage relative to equities and treasuries, again, there's some weirdness going on, right? There's this gold versus real yield weirdness. There's weirdness in these disconnections, dislocations of things that have been fairly connected, in this case going back since 1998. So you think eventually some of this has to give, and this is where the equity doomers are pointing, saying, look, these alligator jaws are going to close, and they're going to close by US equities coming down. So when stuff starts to hit the fan, there will be signs that we will point to, but it's just not enough right now. You know, maybe the fiscal dominance situation is just overcoming all of this, and it just doesn't matter. We also have record money sitting on the sidelines, in quotes there, on corporations. We have record money in Berkshire. Buffett saying he doesn't know what to do with this. Nobody in Berk knows what to do with this. They don't have a great place to put this money. They're getting yield on it. Why bother, right? If we look at retail money market funds, continuing to push all-time highs here at almost 1.8 trillion. That's just retail money markets. So a lot of this money probably won't just magically shift into risk. A lot of it's probably going to shift from the short end to the long end, but I'd imagine some of it will eventually work its way into risk. I mean, just using myself as an example, I've got money parked in money markets right now, right? I'm waiting for things like the 4-hour BitX chart, right? I'm waiting for this to break out and then we can talk. But until then, I'm just going to wait and see what happens because I don't see a strong reason to just jump into risk here after it's had such a great jump since October. It makes sense. We take a breather, we see what's going on, we assess the situation, and then if there's an impetus to move higher, we will. But in the moment, short end yields are very, very attractive for most people. Looking at some charts from Tavi, he is very pro commodities. So he's going to post and discuss things that are pro commodities. Just keep that in mind. But he makes some good points here that money market funds relative to total equity are potentially signaling a market high rather than a market low. At least that's my read on this chart. Similar to like tethered dominance, where tethered dominance or stablecoin dominance hits a high versus a low, sort of signals, again, loosely like money on the sidelines, risk on, risk off situation. And I think to Tavi, this would signal, again, those jaws need to close by the US equity market coming down. It doesn't necessarily mean we're going to see some massive infusion while the US equity market stays flat. And then we can also look at money market funds relative to the money supply. And again, most of this looks like it's sitting in equities, right? This looks like not a bottom, but again, my layman's understanding of this chart would be this shows risk being overvalued relative to historically in money market funds. Looking at GDP estimates, we're still well in the non-recessionary wheelhouse at 3.3%. And not much else to say. Still pretty bullish as far as GDP is concerned. That is definitely not ticked down significantly. Some quick housing data points here. There was a housing survey just got released suggesting that we may see mortgages rise to 10%. At least that's the expectation. And Craig laid out sort of this scenario where you can't cut, you can't raise, you're kind of stuck no matter what goes on here. What this means for the housing market, it's tough to say. It's certainly not going to unlock a bunch of people who don't want to move. It's going to increase cash purchases off mortgage type stuff activity. And ultimately it just hurts those who can't afford a mortgage because mortgage plus housing prices just are too much. They don't make sense. Looking at housing affordability, lower score is less affordable housing, and that has just plummeted, continues to plummet since 2008, since 2019, and is at its lowest point since the 80s. So it's very rough out there if you're trying to buy a house right now. Mortgage payments as a percentage of income, extremely high relative to historic levels. Again, back to the 80s. This looks like essentially the inverse of the affordability chart. Monthly cost to buy a house screaming at over $2,700, well above the pre-pandemic trend, well above housing bubbles, 18% mortgage rates, right? This is the difference between the 70s and 80s. And now, yes, rates are down from 18%, but the value of the home, the cost of the home, is up significantly. So it's a much different story. We are not seeing housing prices come down relative to rates, and that's really squeezing people out of the market. And this is potentially why people just have more money, at least on the high end. This is the number of households that earn at least $1 million, more than quadrupled between 2017 and 2022. The high end is doing extremely, extremely well. The middle and below the middle, not so much. The rich-poor divide seems to be getting worse significantly. You're either paying the interest rate or you're getting paid based on the interest rate, right? And if you're taking out loans, you're just getting further and further behind in this environment. So it's a really tough place to be for the Fed, for anybody on the lower end, paying credit card rates, paying car loan rates, paying mortgages at this level. It's very, very rough. Flipping gears to charts, dollar had evidence of a potential falling wedge breakout that reversed largely on the UJ intervention, where we saw USD weakening. FOMC helped the dollar weaken, and then those unemployment numbers helped the dollar weaken further. So again, if you're bullish crypto, this is exactly what you want to see. You want to see bullish reversal patterns fail on the dollar. We want to see the dollar sub 100 post-halving. That's where the money's been at for crypto. This doesn't look like a complete failure of a pattern yet, but it certainly leans on the failing side for sure. So the more bearish this gets, the more bullish things like Bitcoin should get, and the less of a dollar strength headwind we will have. As far as the S&P, looking at, in this case, 2012, which was an election year with war protests. If we're looking at, where the sun was shining when I was eating a red apple on a Tuesday in the middle of Nebraska, this type stuff, the seasonality chart suggests a potential bottoming beginning of June. This is one data point to compare to, so take that with a grain of salt, but interesting nonetheless. Back to Berk for a second. Berkshire versus the S&P past 20 years. Very interesting to me that it's basically 1-to-1. If you go back since 1965, okay, Berk's done great. But past 20 years, there's really been relatively little difference between Berkshire and the S&P, just continually suggesting that, look, it's about the money supply. It's not really about anything individually, any of these companies. Nothing really matters. Capitalism, whatever. Nothing matters, right? It's just the money supply. The money supply is really helping buoy a lot of this stuff equally. Looking at the S&P here, the SPY on the 4-hour, you can see the excellent bull trend capture we had on the cloud here from November to April. Taking a quick pause here, and we're back above the 4-hour. So we don't have a bullish cloud, we don't have a bullish TK cross yet, but this looks pretty good so far. This may fail, this may not lead to bullish continuation, this may just stay in a range, but the longer this leans bullish like November, the higher the likelihood, at least an attempt at moving higher. As far as the tech stuff is concerned, this is why people care about the Mag 7. Most of the fund flows are going into technology. Nothing else really matters. And that's why people are really hyper-focused on Mag 7 and tech. QQQ, same thing as far as relative to the SPY. On the 4-hour, back above the cloud, not quite bullish cloud or bullish TK cross yet. This could fail, this could stay in the range, but it is leaning certainly more bullish than it was over the prior couple weeks. And this could get noisy like it did August, September, October. But from a bullish crypto side of things, we certainly want this above the cloud. That's where we want to live. As far as the Mag 7 are concerned, Google still continuously looks the strongest to me. Tesla, the weakest. Apple, the second weakest. Both of those still below inside of the daily cloud. NVIDIA has actually recovered quite nicely. Amazon also at highs. So these three, Amazon, NVIDIA, Google, certainly look like they are ready for an all-time high retest. Microsoft, Netflix, Meta, weaker than Google, certainly stronger than Tesla and Apple. But as far as trends are concerned, a majority of these look pretty good. It's just Tesla and Apple that don't look great. They look angry in Tesla's case, ranging in Apple's case. Here's the SMH semiconductor ETF on the daily cloud. This is the crypto cloud, but whatever. We're still seeing evidence for potential bullish continuation, just like we did in May, just like we did in November. Price above the cloud, bullish TK cross. I don't love this up here, to be clear, but the cloud does. The cloud says, look, Josh, trend is bullish. This is bullish continuation. So things look expensive. They seem expensive. Trend still looks pretty much intact. There's other stuff like this, which I continue to talk about because to me, this is one of the better looking charts. This is Morgan Stanley. It's a bank, I know, but it looks great. I love the technicals here. I love that it's done nothing for a couple of years. I love that it's back to the neckline. So I'd much rather trade this than fool around with most of crypto right now, unfortunately. Even gold looks pretty good. 4-hour falling wedge, trying to get back above the 4-hour cloud. Looks fine. Looks like it's probably going to break up. Lots of other commodities. This is WPM. This is gold and silver. Miner combo, amongst other things from Canada. Chart looks phenomenal, right? Looks like Morgan Stanley. Anything that's done nothing for years and years and years, back at the range highs. This is the type of chart, my bread and butter. Love it. Much more attractive than crypto right now. Copper, same thing. Looks great. Back at the highs. Makes sense to me over crypto right now. XLE has had some weakness over the past couple of weeks. Still looks fine. Still, to me, at the breakout level. I'm in no rush to close this thing. As long as it's above the weekly cloud, totally fine. You know, a lot of these charts took years to consolidate, and you just got to give them breathing room to break out or not break out. But I'm in no rush to close that in any way, shape, or form. As far as the crypto adjacent stuff goes, MSTR had a pretty aggressive downtrend. It looked like it probably wanted to go a little bit further on an Adam and Eve or Head and Shoulders up there. It's back in the cloud as a bearish TK cross. You could argue maybe falling wedge, but again, all this is sort of wishy-washy, not really where I want to be. I'd feel much more comfortable opening a position at MSTR way down here than up here. Or what you want to see is a bullish TK recross with price above cloud, and you don't have that either. So as all bulled up on MSTR as people are, this just does not look attractive to me up here still. And what you really want to look at is the Bitcoin treasury price relative to MSTR market cap. That still is probably very out of sync. So I'd much rather trade BITU or something else relative to MSTR. Coin, kind of the same thing, just middle of the road. Doesn't look great, doesn't look amazing. It's better to be a seller in a trend at the top rather than the middle. It's better to be a buyer at the lows than the middle. So again, not really much going on here. Cycle-wise, as long as this continues to ping pong in the trend channel, this could just keep going until Bitcoin is done, right? That could be 500 plus, I don't know. So from that perspective, long-term, it looks fine, but in the midterm, there's really nothing here. You know, it's just taking a breather. WGMI, same thing. This thing has been all over the place on the daily. Daily cloud is neutral to bearish. Just not much to do on the mining front yet. You know, this just needs time. There's just no signal here whatsoever in the near term. Mara was up pretty big today off of S&P 600 inclusion. So we're getting closer. We're getting closer to everybody slowly owning Bitcoin in some way, shape, or form, whether it be through MSTR in the S&P 500 or Mara in the S&P 500 or whatever, right? All these companies are companies that own Bitcoin on their balance sheet. So we're getting there. Looking at this old inverted head and shoulders target, you know, we still have a ways to go on that. That's a 2x plus, that's 2x to 5x, something like that. Will this outperform BTC? I don't know. A lot of the mining bulls think so. I'm not quite sold on that. To me, in the near term, WULF looks like the best miner still, consolidating above the daily cloud. This is 4x to 5x plus potential based on measuring the range here. So if I'm going to trade a miner, I'm trading this one. I don't really like any of the others specifically or individually. It's either that or you just throw up your hands and say, you know what, I'm bullish miners. Let's buy WGMI. This is Square. Like I mentioned in the open, they're adding monthly Bitcoin purchases to their treasury. So eventually, I would assume that as Bitcoin gets more bullish, this should break out in a big way. That 70 to 80 level, 75 to 80 level has been pretty big resistance since like 2018. So if into Q4 we can get above that level, I like this a lot. You know, it may just be dead money until then. I'm just going to hold this out. I have a smaller position in it, but it looks okay. You know, they're getting slapped with Wells notice and whatever else from the government, as is Hood. Got it slapped with a Wells notice from the SEC today. This chart still looks fine to me. Trend on the weekly looks great, well above the range. And then lastly here, PayPal, another crypto adjacent company that is slowly starting to turn around. Falling wedge, inverted head and shoulders. So look, there's options other than trading just, you know, Bitcoin or some of this other stuff. There's other stuff out there that in this slop and chop range looks more attractive than maybe forcing something on Bitcoin, at least probably for the next couple of weeks, I'd imagine. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.